Hello, my name is Simon Evenett. I'm the co-founder of Project Firefly. Welcome to this debate on oil prices. Since June, the price of oil has fallen 45%, and this has had a substantial number of political, economic, as well as financial market ramifications. The purpose of this debate is to explore these issues. In this debate, we'll be joined by 4 Project Firefly community members and 2 leading experts. This debate draws together 2 streams of thought leadership from Project Firefly. The first stream is supported by the Financial Times, in which we have a community of young talent who are commenting on newspaper articles on a regular basis. The Financial Times has kindly sent us James Mackintosh, their investment editor, and I'm delighted to welcome James here. The second stream of thought leadership is supported by Credit Suisse. Credit Suisse sponsors our Emerging Leaders competition, which is held in the spring of every year. Next year's Emerging Leaders competition includes a question on oil prices, and so there's a direct relevance to this particular debate. We're delighted that Giles Keating, who takes a very senior role, a leading role in investment allocation at Credit Suisse, has been able to join us as well. I welcome both of our experts, Giles and James, to this debate, and I'm grateful that they've been able to spare their time from what must be very busy schedules. And we're joined by 4 Project Firefly community members. We're joined by Gregory Marks from New York. Gregory is an economics student at Fordham University and has won our Emerging Leaders competition before and attended the Asian Investment Conference in 2014. We're also joined by Maryam Yussuf, who is now based in Nigeria, but she's the graduate of Brunel University in the UK, and I'm told did a stint at the UK Treasury as well. And so welcome to her. And then we have Ben Mueller, who's Swiss, joining us from the LSE, where he's doing a PhD. And congratulations to him. He's been in the past an honorary mention in our Emerging Leaders competition in 2012. And last but not least, we have Radoslav Dragov from Rotterdam, where he's at the Rotterdam School of Management. He's just finished his MSc in Organizational Change and Consulting, and he is a competition winner as well of Project Firefly. So, welcome all, and let's get going, cracking with the debate. I'd like to ask James first if he has any opening comments to help us position this particular debate on where oil prices have come from, why, and where they're going, and what factors we should all be watching and tracking. James, please.
Well, I think the basic question that everyone has to look at here, whether you're looking at it from a financial point of view or an economic point of view, is this about demand or is this about supply? If this is about demand, then this is very bad news that oil prices have fallen. They're now down, well, this morning when they hit their low of the day, they were down 48% since June, which is a pretty extreme fall. That's in Brent crude over such a short period of time. It's one of the most extreme falls of the past 50 years. Ranks about 4th or 5th, depending on exactly how you measure it, over such a short period of time. It's a very big deal. It's one of the most traded commodities it's the most traded commodity in the world. One of the most traded financial contracts in the world. This really matters. The question is, does it really matter in a good way? Because it means that the West gets cheap stuff. It's going to be good for the economy. That's the optimist view. Does it really matter in a bad way? Because actually this is a signal that the world economy is slowing, that things are getting worse. And on top of that, that it adds financial pressure because there's an awful lot of debt tied in to the oil market. This is obviously an important question. The market did seem to have decided that this was a supply-driven question. This is about the Saudis changing their reaction function, that they, rather than doing the usual thing that as demand falls a little bit, they cut back production a little bit and maintain prices. Instead, they've carried on pumping to the full, and the market's been shocked by that. Now, if that was all there was going on, then that should be a good thing unless there are knock-on effects within the financial system. But it's with all these things, there are always 2 sides to every story. Of course, the reason oil prices started falling in the first place before the Saudi change became evident was somewhat of a drop in demand. So how you balance those 2 things in economics matters, but also how you balance them within the financial system matters a lot. I think that sort of provides the outline of really where the discussion should go, probably.
Thank you very much. Giles, what would you like to add to that overview which we've just heard?
Number one, a bit of historical context, longer-term historical context. I think it's worth remembering that with volatility, oil prices for a good period of about 25 years between sort of the middle 1980s or the early to mid-80s and the late sort of 2000s, sort of 2006, 2007, traded in a range, roughly speaking, 1/3 of the $110 a barrel for Brent that we have recently become used to. So they traded somewhere around the $35 a barrel level, one side or the other, if you adjust for inflation. And in that sense, the kind of $110 a barrel, give or take, and a range around that we've all become used to, and from where we have fallen, in that sense, that 110 is a bit of an historical anomaly. And in fact, if you leave out some of the sort of spikes associated with wars and OPEC embargoes, in real terms, it's one of the kind of historically, well, it is the highest ever sustained level that we've had. And I think we know why prices shot up from that sort of 35, give or take, to the 110, give or take. It's because China and other emerging countries massively increased their demand over quite a short period of years, while the supply just wasn't coming through. So I think, you know, during, through, and just after the financial crisis, we in effect had a demand shock to oil because of all that demand from China, which forced the price up to about 3 times the level it had previously been at. And in my view, by the way, that's one of the reasons why global developed economic growth has been rather miserable over recent years. People are always talking about debt and the aftermath of the financial crisis. They don't realize we've been suffering from these ultra-high oil economics. One tells us that if you then, even if the supply elasticity in the short run is not very good, in the medium term, a response. And I think that's exactly what's been going on over the last 3 or 4 years, particularly, of course, in the US shale industry. US oil out round numbers by 50% from about 9 to 13.5 million barrels a day over the last 3 or 4 years, which is an astonishingly rapid response, reflecting how flexible shale output is. And so I think we could say that that we've quite several years been in the making of bringing oil prices back down from this kind of historically crazily high 110 level. We're now in process of seeing that actually happen. Of course, there are question marks as to why it suddenly happened so rapidly. Part of the solution to that is because the sort of growing output from the US and elsewhere was rather hidden by the collapse in output from countries like Nigeria, as well as in particular Libya, where production used to be 2 million barrels a day and fell almost to 0 earlier this year. So I think you've had a kind of weird effect where the fundamental economic forces of exceptionally high prices were bringing forth extra supply, but that got masked by these temporary outages. And now some of the outages are a bit less extreme than they were. Like Libya, for example, has actually managed to restore some of its production. And meanwhile, the shale output, until very recently, has just carried on ploughing upwards almost without limit. So I think that did largely lead to an excess supply situation. There may have been a bit of softness of demand as well, as James has remarked. But I think we should all accept that $110 a barrel was a crazy, unsustainable high level that really was acting as a major drag on the global economy. And now we're kind of in process through a series of discovery and probably overshooting in process of finding a new equilibrium level. By the way, one final point to chuck into the discussion. Everybody always thinks about oil prices in terms of the demand effects, the way that it shifts purchasing power around economies and between economies. Let's remember it's a vital supply input. And so if you think of a production function, when you raise, as we did in 2007, 2008, when prices tripled, when you raise the oil price massively, you reduce the productive potential of the economy. When you lower oil prices, as you're doing now, you improve the productive potential of the economy and make it much easier to bring unemployed resources in labor and capital back into production.
Thank you, Giles. But on net, that sounds like it's potentially good news, right?
If we look to the medium term, I mean, this is a massive positive supply shock relative to where we were 3-4 years ago, which, as I say, the effects of which have been obscured. And supply shocks in general are good news for economies. Of course, supply shocks mean you've got to have enough demand to go with it, so there may be adjustments to monetary policy that are required. But of course, it's good news. However, in the short term, obviously, you have potential disruption to financial markets, as James was stressing. The US high yield market looks as though we're heading potentially for at least heightened risk of default. That's already reflected in the prices, maybe some actual defaults, and that's all disruptive in the short term.
Thank you very much. Maybe I could turn now to our Project Firefly community members to get their opening statements as well. Gregory, please.
Thank you, Professor Evenett. Yeah, so as Mr. Keating said, we've been in the making of this move, but what's the trigger? We all know the fundamental demand story and supply side. These things are all valid, and they have been for some time. But the market didn't just wake up to these facts overnight. We've seen, as mentioned, a spectacular 48% decline in the last 6 months. And I see this trigger as being primarily a result of expectations of a Fed rate hike and the global short squeeze in the dollar that it has prompted. The world has been borrowing in cheap dollars in the hunt for yield over 5 years, and the threat of a rate hike is unwinding positions in the dollar market very rapidly. So that strength means you need less dollars for that barrel of crude. If you look at the historical relationship between the price of WTI and relative dollar value, current USD strength warrants a $53 handle on crude. So I look forward to discussing the pros and cons. I would slightly challenge, some narratives calling this a positive move in the short run. I see the crude move as being a symptom of much larger factors, and at the end of the day, we can't view this simply in the context of cheaper energy. This sort of volatility is not going away in a rate hike environment, and I have no doubt prices will come back in some way, shape, or form over the next 12 months, as they tend to do after these moves. But market volatility is never favorable for stability.
Thank you, Gregory. Now I'd like to turn to Ben. Let's hear your opening statement, please.
Yes, I'm very much looking forward to discussing the drivers of this correction in the oil price that we're witnessing with all of you. I personally am struck by some of the parallels to another major oil price correction that we witnessed 25 years ago in the 1980s, the oil glut. Then, as now, a prior period of abnormally high oil prices brought a range of new producers into the oil market, producing an oil glut. Then, as now, this was accompanied by a period of aggregate demand weakness in the Western world. Then, as now, the Saudis refused or balked at cutting supply, although initially they tried, and it now seems they've learned that lesson. The implication being that OPEC comes under strain and the logic of the cartel is being weakened. Then, as now, Russia is one of the main producing countries to suffer geopolitically from the oil price correction. And then, as now, I feel that the consumer countries, primarily developed countries such as the US and Japan, stand to benefit. And that is because I feel the super cycle in terms of commodity prices is coming to an end. As Giles suggested, there are some inbuilt feedback loops into the global commodities system that make it fairly reasonable for prices to come down after they have been unsustainably high. But I do understand that some of you take a less sanguine view of this, and so I look forward to discussing it more with you going forward.
Thank you, Ben. Let's go to Rado. Rado, please. Let's have your opening statement.
Yes. Many commentators have been arguing whether the low oil price is going to be a good or a bad thing for the world economy. And clearly there will be some winners and losers. But what I am more interested in is the longer term consequences of the low oil price. For example, what will happen to the shale oil industry in the United States? Because this is an industry very much dependent on high oil prices. So it stands to reason that at least in the short term, there will be some investment cuts and maybe some small oil companies will go bankrupt. But I believe that the shale oil industry won't be negatively impacted by the low oil price because the shale oil industry, I think, is very flexible. Another question concerns the future of OPEC, because in the most recent meeting in Vienna, Saudi Arabia decided not to cut its output, and many think this is a historical precedent with long-term consequences. So it will be interesting to see if there's some diverging interests and differences among OPEC members and how they will develop in the future. And the final question concerns Russia and whether the economic troubles will actually be a catalyst for positive change in Russia. I don't think so. Russia has ample reserves, and Putin has very high approval rating, and he is still as determined to cling on to power. So these are my thoughts about the future, and I'm very eager to discuss them with you. Thank you.
Thank you, Rado. Now I'd like to turn to Maryam, please.
Thank you, Professor Everett. Well, I think it's very clear that we live in a crude oil-driven economy, and the prices over the last 3 years have been abnormally high, and I think these prices have driven the increase in supply and output that we're seeing in the US. I think investors and oil producers, especially from North America, were expecting these prices to continue to stay high, and I think that they're really going to have to think more evaluatively about how they can cut down costs based on these prices. I mean, the US alone is one of the biggest contributors to non-OPEC oil production. So I think going forward, the implications are going to be quite severe for these oil companies. Their output in the future is going to depend on how much financing they can secure, basically. And if they can continue to secure the financing to continue to produce, then they will be big players in future demand, in future supply. But more importantly, I think my opinions are geared towards the emerging markets, particularly for oil producers like Venezuela and Nigeria. They're very heavily dependent on oil yields. We can see that the depreciation in currencies is really having a dire effect on their economy to the point of default. I mean, the Venezuelan bolivar, depreciated almost 50% over the last month. So it's becoming very critical for these countries, and I think in the long term they have to reevaluate how they can diversify away from crude oil and this heavy dependency on petroleum crude oil income. So I think going forward, the implication is going to be how can these economies adapt? How can they provide more sustainable sources of revenue for their domestic economy?
Thank you, Maryam. Thank you for that, making the link. It's certainly back to emerging markets and the diversification challenges, which we've debated for almost for decades, it seems, and back with a vengeance. So when I listen to all 6 of the contributions, I hear some themes based around short-term and longer-term, and maybe that's the right cut. I'd first like to turn to James and ask, you heard Gregory link these movements in the oil price to the movements in the dollar and expectations of the Federal Reserve Board policy changes. What do you think of that argument? Is there any leverage in that?
Well, it's plausible that the dollar move in particular is relevant, but it's odd that this didn't happen last year. So last year we had the taper tantrum, which saw some very big moves in bond yields in the short year in Fed rate expectations, basically moving the bond yield a lot from last May onwards, and that didn't lead to a crash in the oil price. This year, for some reason, it has. It's the coincidence that June was the point at which both the dollar took off and oil started plummeting is too great to overlook. On the other hand, it hasn't been particularly closely correlated. In fact, oil is somewhat less correlated recently than it normally is with the dollar. So It's not that on good days for the dollar, oil falls more than on bad days for the dollar, for example, in the recent fall, which might just be because panics kicked in, so the market disconnects. There is, of course, always a very long-run inverse correlation between the dollar and oil, simply because one is priced in. I mean, oil is priced in dollars, so obviously a stronger dollar means cheaper oil. But the fall has been a lot more than that. And the fall is obviously suggesting some serious problems. So whilst I think the dollar does have a partial explanatory effect and possibly even a trigger effect here, it's not the full story. And of course, we've already heard about some of the supply issues, but there are lots of, I do think the big shift by the Saudis to change the way they react to weaker demand does have a big effect.
Thank you, James. Turning to the longer-term themes, when I was listening to Ben and to Rado, going back to the 1980s, and Giles, you started off with some historical parallels. What do you make of the parallels which were raised by our participants?
I think they had they actually gave some very good parallels. I think this parallel with the oil glut in the 80s was very well taken. Certainly at that time, I love the idea that the parallel then that Saudi and the other core OPEC producers. I think one can think of the core producers in OPEC. You can perhaps add Kuwait, UAE, maybe alongside Saudi, as acting semi in concert. Maybe not always, but semi. They clearly allowed the oil price to fall. At one point, it fell to a low of $8 a barrel, having previously been trading at $30 or above. So that was a fall of about 75%. And they did that deliberately to bring into line the recalcitrant members of OPEC who were refusing to take their share of the cuts. And subsequent to that, they did come into line and the price rebounded to about $18. Historical analogy with that. I think the difference this time is that although Saudi and the other core OPEC members have got, and Maryam was mentioning, the pressures on countries like Venezuela. Although I think they've got, Saudi and co have got the idea of bringing the recalcitrant OPEC members back into line. But I think the bigger prize for them is really to even actually stop the output of some of the shale oil fields that are currently in production. The Financial Times, James, has got a great article today about the kind of so-called stripper wells, which at current prices, the kind of mum and pop wells, the tiny ones, really about 11% of US shale output that could come under pressure. But it's not just that, it's also a matter of crowding out the new investment, because shale output doesn't last for very long. Many of the wells, reach a peak production and then decline quite rapidly. So if you can crowd out new investment, then you can stop the output going up or even actually bring it down quite rapidly. So I think this is what Saudi has in mind as much as bringing the OPEC members into line. So it's a good analogy with the past, but it's got extra subtleties to it.
Thank you. Now, Rado raised the issue of the potential responses in Russia to this, and this has both political, foreign policy, maybe even military dimensions, not just economic. And I noticed in today's, at least on the web on the financialtimes.com, Gavin Davis was making the same argument that the biggest unknown and potential negative surprise concerning oil price fall was indeed Russia's response or potential response. Well, I think I want to turn to Ben, because Ben, you're doing a PhD in international affairs, so you ought to have something to say about this type of thing. What do you make of these possibilities which have been raised by Rado and by Gavin Davis?
Yes, indeed, and that is also whence the oil glut analogy comes from. It's interesting, in the run-up to this conference, James commented on the fact that economists don't have a theory of finance. Well, what they also don't seem to have is a theory of how to integrate politics into their models. And it's quite right that there are some major political implications to the current developments on the oil market. Russia needs the oil price to hover around $100 per barrel in order for it to balance its budget. At current prices, it will come under severe strain, and Vladimir Putin will have to respond one way or another. Reserves will have to be drawn down, and only the Russians know how long that will last. Budget cuts will have to follow at some point unless the price recovers. And I really foresee one of two scenarios playing out in terms of Russia's foreign policy. On the one hand, they could use this as an opportunity to extricate themselves sort of elegantly from the mess they've created at Eastern Europe's borders. I think that's quite unlikely for the simple reason that Vladimir Putin seems to have wagered his political future on foreign policy bravado. So the far more worrying possibility is that Putin will have to clamp down even more domestically in order to entrench his position. That the drop in the oil price will mean hardship for the Russian people and increasing levels of despotism in an effort to maintain the political status quo. We don't know which of these scenarios will come about because in large part they depend upon the perception in the Kremlin of what is happening, but there are definitely changes to come one way or another, and we better prepare for some tumultuous times ahead geopolitically as a result of what is going on at the moment.
Thank you, Ben. I mean, maybe we can turn to Maryam, because the oil price shocks has had quite interesting effects in some other emerging markets as well. You discussed the case of Nigeria. We've seen the exchange rate depreciation for Nigeria. You mentioned that the solution being diversification. How would you put together a diversification program for Nigeria? What would you recommend?
Identify areas where Nigeria has a comparative advantage, whether it can compete on the global market. Nigeria has a wealth of natural resources, coal, timber, and has massive comparable agricultural land that they can use for cash crops and really benefit from cash crop exports. But I think the issue is that all governments and administrations have failed to invest significantly, and it's going to be almost quite now, but at least they have to start somewhere. I think the important thing is the revenue that we currently have into promoting these sectors, finding incentives for farmers, for the agricultural sector to continue investing in these different cash crops and provide.
No, you're back. Okay. I think I got the gist of it initially. You were making the point that that Nigeria needed to move away from oil towards other types of primary agricultural crops and natural resources. And I guess we could, in principle, down the road, potentially also manufacturing, if that were indeed possible, to be developed as well. Okay, that sounds good. Now, Giles, what's the track record of countries diversifying effectively after these big commodity price shocks? I mean, is this something we should expect to see unfold over 5 or 10 years, or is it something which happens faster?
No, I think it does take a long time. I mean, obviously, there are lots of precedents here, as your question is suggesting. And of course, the classic words that are probably on everybody's minds are Dutch disease, which, as everybody remembers, refers to the problems that were experienced in the Netherlands back in the 1960s when they discovered gas, and the real exchange rate rose too much, and the economy that crowded out the non-resource sectors, damaging the economy. And I think sensible countries, having learnt that rule, we got a bit of that in the UK in the 1980s with North Sea oil. Sensible countries, having learnt that rule, have tried to take advantage of phases of very, very high natural resource income to put money into a reserve fund. Norway, with its sovereign wealth fund, is one of the classic examples. And I think if we look at the various major oil producers, we can kind of grade them a bit by how far they've kind of done that. I think Venezuela probably hasn't really done it at all. Maryam, you'll know much better about Nigeria than me, but I guess Nigeria hasn't really done it. Russia, interestingly, has done it to an extent. They have built up extremely large foreign exchange reserves, as it were, during the good years of the historically unusually high oil prices. And that does give them a big cushion for dealing financially with the current problems. Obviously, they're also facing the problem of the sanctions. I think if you hadn't had the problem of the sanctions, then Russia would have actually been in a reasonably good place, given, certainly relative to other oil exporters, given the reserves that it has built up. All of these economies now have to try and reverse the effects of the Dutch disease. That does mean having a lower real exchange rate. It does mean diversifying their economy, whether it's into other primary commodities like timber or some of the things they have in Nigeria, whether it's trying to get the manufacturing, the high-tech sector going, which Russia is certainly capable of, given its history, but has not succeeded in doing in these recent years. But I think we have to be realistic. All of these adjustment processes, if we're looking 5 years, I think we'd be moving fairly fast to do it within a 5-year period.
James, can you walk us through what you think is a realistic way of thinking about future prospects of the US shale gas sector, please?
Well, the break-evens that are calculated by various analysts range wildly for shale, because it all depends which area of shale they're in the States. But the break-evens tend to range from sort of $40 to $70. Now, in the short run, the outlook is financially very bad, in the sense that a whole lot of them are, or the market at least, is pricing that they're teetering on the edge of bankruptcy. That, of course, doesn't necessarily affect their production from the existing wells, because after they go, if anything, it extends the production, because what will happen after they go bankrupt is that the creditors will seize the assets and they will continue to produce as much as they possibly can to try and get the value out of those assets. So in terms of short-run actual production, I would expect shale to continue pumping as much as it can, as long as it can, because so much of its cost base is already sunk cost. There's no point in stopping production. Obviously, if there does come a price that they would actually have to stop because it's not worth pumping the chemicals into the ground anymore, but that would be a long way down even from here. But there is a much bigger problem, which already heard raised, of course, that if you just leave shale and don't do anything, then in 3 or 4 years, there probably won't be very much shale production, because it falls off so quickly. They have to keep drilling these new wells. And financing new wells at this moment is becoming, well, basically impossible. No one's going to lend money to drill a new shale well. So if the problems in shale come through and continue to come through and oil stays down here, then shale will, over the next few years, shrink quite rapidly. Unless the alternative, of course, the unknowable is that technology comes through and allows another burst of cost cutting within shale, very low cost production. This has, of course, been exactly what's been driving shale for the last few years. So it might continue to come through, but there's no way to know whether there's another new breakthrough that's about to cut the cost of shale even further.
Thank you, James, for that overview. That was very helpful. I'd like to turn now to Rado and to follow up on his earlier comments about shale gas. I'd like him to outline how he thinks the shale gas sector is going to evolve in the near to medium term in the United States.
At least in the longer term, at least it's bright. As we mentioned, the production of shale is very flexible. If the price is low, the companies can just stop producing, or when the price gets up again, they can start producing again. And also there's the problem. It comes with geopolitical costs. The United States tried to be as independent as possible from other countries. The United States has a very unique environment with lots of cash, sometimes loose rules, and I think that guarantees the future of the shale oil industry.
Perhaps we can turn now to Maryam, please, for your closing remarks.
Current vary based on the Brexit price. Hopefully, it will level out to the sort of $90 per barrel average that we've seen in the past. But the most important question now is to what extent or how much damage will be caused because of the current fall, and if prices continue to fall even further in the short term, how quickly can particularly the financial markets pick up and bounce back, and what consequences will this have for monetary policy, particularly in East Asia and also in the West? But I think more importantly, it's good to assess where demand will be coming from in the future. I mean, OPEC has, categorically said that it is not willing to reduce output at this point. So it's up to demand to rise and mop up the excess supply. And given that 90% of the world's population is in the developing world and emerging markets, demand is more likely to pick up from there, given decline from OECD countries. So it'll be interesting to see how demand picks up in the medium to short term, and the extent of the damage and how quickly we can recover from it.
Thank you, Maryam. Let's turn to Ben, please.
So my offering as regards shale is the following. Clearly, Saudi's strategy seems to be driven in part by an effort to undercut new entrants into the oil market. At the same time, there seems to be a consensus that, on average, and I do understand there is incredible heterogeneity in terms of different shale projects and shale production costs, but that, on average, at about $60 a barrel, shale becomes financially attractive across the board. So my thinking is the following. Whilst the immediate consequences on the shale industry are unknown, or rather remain to be seen, because as James said, we're not exactly sure who can produce profitably at these oil prices. It seems to me that in the long run, the entrance of shale on the world market puts a lid on oil prices, because one feature of shale, as Dragov said, is that yes, oil wells run out very quickly, but they can also be set up to produce very rapidly. The point being that there seems to be a new feedback loop in the oil price system, if you will, in that once oil breaches a certain barrier, it will naturally come back down on account of the fact that shale will offer oil at the margins. And of course, total shale output is still very small as a proportion of world output. So the point is that I think shale will put a lid on the oil price going forward, and that's something that could possibly influence the futures market and also the oil price going forward. That we're no longer going to see triple-digit oil prices as we have in the past.
No, at least Gregory, let's hear your concluding remarks before we wrap this all up. Thank you.
Yeah, so in conclusion, and sort of circling back to shale, it's up for debate whether we see, this volatility in crude markets sort of spill into high yield risk markets. So, it's been said that triple Bs and C-rated high yield energy companies could, 1/3 of them could face default or restructuring under those conditions. So if that spills over into the high yield market, you could certainly see a lot of issues. And in addition, the consumer story in the U.S., you hear a lot about it. Lower energy prices better for consumers and the broader economy. Well, that's only the case if the expenditure multiplier in the non-energy space is greater. And I think that's up for debate. The best data has been coming out of places like Texas, North and South Dakota. Those petrodollars aren't going off to Saudi Arabia, as politicians like to say. Those dollars are going into real estate in Houston, salaries in the Gulf, shale fields, energy sector capex, and in the highway trust fund. Those marginally higher amount of dollars spent in retail chain stores as a result of savings are not going to translate into higher salaries. They're not going to translate into greater domestic apparel production. Those dollars are leaving to the mass production centers in the East, and earnings staying at home. They may only provide benefit to big box earnings side. So certainly nobody's buying a house on that extra $250 this year, or $500 next year if we assume that the current price regime holds.
Thank you, Gregory. Let me try and draw this together by thanking Giles and James for joining us, and thanking our 4 contributors for contributing to this Project Firefly debate on the oil price causes and consequences thereof. This has been a terrific opportunity, I think, for us to have this 7-way discussion, bringing together people on different continents, and I'm really delighted that you could all contribute. Thanks for also bearing with the occasional IT and technical problems. This was great. Hopefully it didn't detract too much from the substance, but I'd like to say a big warm thank you to all of you, and thank you again to James and to Giles for taking time out of their very busy schedules. Thank you all and have a great day. Bye-bye.